Everyone, this is Gary Wilson. Welcome to this week's live Path to Profit webinar. Welcome aboard to everybody who's in the rental program, particularly those of you in the M1 group, near and dear to my heart because I'm a GoBundance brother, champion level, and we really do pride ourselves in helping people get to their first million. So great mastermind group. I mean, it's done wonders for me. Believe me, there's people in the group that are doing even better than I am. I mean, they publicly will tell you what their net worth is, and it's pretty astounding when you have guys in the group worth 30 million and 80 million dollars, So welcome aboard to all you guys, right? Also welcome aboard to everybody who's new to the Investor Agent Program throughout Ontario and Quebec and the New England states. I've been up here for about a month now. I just had another dose of crab and clams and lobster. So this would be my last week here for a little bit. Then I head back to Canada. Oh, by the way, so my schedule. This week, Massachusetts. Next week, Toronto. Okay. And then pretty much the entire month of October, I will be in Pennsylvania, with the exception of 1 week. I'll be in Delaware the week of October 16th, but every other week I'll be in Pennsylvania. And that's actually my my original home region. I don't live there anymore, but I was there for quite a long time. Most people know me from that region. So in any case, welcome to all of you. A little bit of housekeeping. You'll notice you're in default mode. I'm sorry, by default you're in mute mode. And obviously that's by design, because if we had all 100 of us, live online at the same time, it'd be chaotic. So you're on mute. From time to time we will unmute you and bring you on. So like Billy Maloney, I might unmute him for further explanation in his email, perhaps. We'll see. This is being recorded, and so some of you, if you're not on live now, you're going to get this in recording mode. You all will, actually, and I highly encourage you to replay this. You can use YouTube to MP3. It's an application that allows you to convert the file to MP3, so you can listen to it in your car or over your phone, whatever you want to do, if you happen to be on the road, that is. And also just to refresh your memory and get fresh notes. Also, the emails that Beverly sends out, guys, this is really, really important. Definitely pay attention to the emails that Beverly sends, because she gives you lots of updates on the systems, the training platform, material updates. In fact, we're always working on updates. We're working on some right now, in fact. And also the webinar schedule and my personal schedule. So keep an eye out for that every week. It's really the best way we have to communicate with everybody, because everything's in writing. And that way we know everybody gets the same information the same way. In any case, let's go ahead and get started here. If there are questions, please use the question box. As a matter of fact, let me do this. Let me just check real quick here, guys, to see if we do have any questions. So far everyone's saying hello. Hi, everybody. And let's see, audio is working, video is working. So I think we're in good shape so far. Let's see. Luann is saying, yes, I hear your voice. I see your email with Billy Maloney. And I guess you guys know each other. Let's see, Cedric. Yeah, Cedric, I'll give you a buzz, man. We've got each other's phone numbers. I'm just not sure the arrival date and the departure date. I know it's going to be the weekend before Thanksgiving. I've got to be tied up Saturday and Sunday. I'm hoping to fly in early Friday, have some time to maybe walk the beach in Malibu, see the sunset, on Monday, be able to take my time coming back east. So I'll keep you up to date. Okay, Michael, you're welcome, Michael. That was a great call. Let's see. Hey, Rich, good to see you. Hey, good to see you on board, man. All right. Looks like we're all good. Mark Hamilton saying, I'll check it out and send you my thoughts. Okay, I'll get that to you. So Jackie, the booklet, I'm going to show you, Jackie, tonight, the booklet that we use to attract money from investors who are capitalized, but yet they don't really have a lot of time, or they don't have the patience to invest. So we can line up with them to find dollars for investing. And if you're like me and you've got your license, most of you do actually, you can use it to find other investors and represent them in transactions and earn quite a bit of money in commissions. In fact, the funny thing is everybody knows I'm an investor, everybody knows I'm a broker. And what a lot of you might not know is there are a lot of years I made more money in commissions than I made in rental income. Okay, I mean, we're talking, upper six figures. I mean, there was a year I won all kinds of awards. I earned about $800,000 in commissions. So don't ever write that off. If you've got your license, absolutely use it. If you don't have a license, you may want to consider it. Just give me a buzz sometime or email me and I'll fill you in on the details. So Jackie, we're going to talk about that tonight. First thing we'll do is get into Billy's email though, and that was a great lead in. I was going to talk about the booklet, and Billy's email was perfect timing, so thanks Billy for the email. Let's see, Billy says, I'm at work. I actually don't have a mic, but I'm faster typer. Okay, you can type faster than you can talk, but that's pretty cool. Okay, let's see, Jackie. Yeah, Jackie, that's right. I think you guys are actually closer to Woodland Hills. I think you're in Woodland Hills. Yeah, so I'm going to be probably either at the big Marriott right there by the park, or I'll be possibly, there's another Marriott in Calabasas. I like the one by the park because that's where I saw the Beatles tribute concert this past June on Paul McCarthy's 75th birthday, and it's just closer to everything, great restaurants, and go down the Malibu Canyon Road, right, or Topanga Canyon Road, excuse me, get down to the beach that way, so it'd be awesome. Okay, yeah, okay, great. Let's see, that is Billy Maloney. 20-30 minutes from Woodland Hills. That's right, Billy. Holy crap, guys, we should get together out there. Let's see if we can get together a dinner. There's a nice little restaurant on the pier down in Malibu. It gets kind of crowded sometimes, but it's a great place to see the sunset. I know probably every one of you has probably been there. I can't remember the name of it, but good little place, great food, great fish tacos. So in any case, for everybody else who's not in California, you're probably wishing I would get moving forward here. So let's do this. Billy's email. And Billy, I appreciate you being candid and sharing this with the group because this is going to help everybody. He mentions a couple of things here, Fannie Mae, for example. And you'll notice that Fannie Mae makes it very tempting when you're first starting off investing because you can get in with a little bit of money down, great terms, a 30-year mortgage, decent interest rates, but they really are kind of a pain in the butt. And more importantly, I'm going to get into why we really recommend shorter terms and using portfolio lenders. Portfolio lenders are banks that don't sell their mortgages. They're regular banks. They're chartered banks, state and nationally chartered banks. But like in Canada, guys, we don't sell our mortgages. All right. So in the States, you have to find what's called a portfolio lender to find one that doesn't sell their mortgages. Lots of advantages there. So in any case, let's get started. I have 3 mortgages in my personal name, and then I have 1 property paid all cash in an LLC. And by the way, the 3 mortgages, 2 are Fannie Mae, 1 is conventional. All right, so Billy, you probably recognize the conventional mortgage was maybe a wee bit easier, less paperwork, faster. The people probably were more business oriented, than the Fannie Mae guys, right? He's typing in yes, exactly. All right, so my lender told me that rules have changed last year with Fannie Mae, and if you have a property in an LLC and you transfer it into your own name, then Fannie Mae makes you wait 6 months before they will give you a loan. I'm sure that's true. I'm not familiar with that update or that change in their policy, but I wouldn't doubt it because they change that kind of stuff all the time. A couple of things here though. Let's just kind of break this down a little bit. What Billy's asking is, would you advise I transfer title to my personal name right away in order to do a cash out refi with Fannie? Because loans usually they give you the best terms, right? And again, on the surface, Billy, it looks like, yeah, you're getting a long payout period, 30-year. What that means is you have lower payments on a monthly basis as opposed to a 20-year term, which we'll talk about here in a minute. Okay, he's asking, what would I do? I want to get as much cash as I can out so I can buy another property. Well, ironically, we talked about this with Michael earlier, Billy. So let's just do this. First things first. When you have a 30-year mortgage, so I'm gonna show you a calculator here in a second. Let me go. Actually, here it is right here, mortgage calculator. All right. We're gonna go over some examples here and let you see firsthand why we feel the way we feel, about certain mortgages at certain terms and rates and things like that. Okay. But fundamentally speaking, Fannie Mae has much stricter guidelines on when you can pull the money out, how much you can pull out, who can pull it out, all those kind of things. When you have a conventional mortgage, by the way, when you get a conventional mortgage, they're generally with portfolio lenders who are not selling their mortgages. So conventional, they can do that and they don't necessarily have to follow FHA guidelines. See, a Fannie Mae loan has to follow FHA guidelines because that loan is being sold on the secondary market, hence Fannie Mae. Fannie Mae is a pool of mortgages of like kind, and they pull them and sell those. They allow you to invest in pools of mortgages, okay? As a person who likes to invest in the stock market. Conventional mortgages, they don't do that, right? So they have more flexibility, more latitude in working with us. So generally, Billy, for example, a lot of times you can't get a Fannie Mae loan. You just don't fit the model that they're looking at, okay? And they kick you out. Well, the conventional lender, portfolio lender, generally will look more at the project based on its own merits and look at you, of course, your character more closely to see if they're going to make a loan. And they're more flexible. You can get creative with them. Okay, you can do all kinds of neat things. Yes, they will have sometimes prepayment penalties, but they generally diminish over time. And you know, they want to keep your business. There's also the limit on conventional loans, guys. They don't cap you off at 4 properties or 10 properties or anything like that. So when you're doing FHA underwritten loans, most banks will only let you buy up to 4 properties, okay, using FHA underwritten loans. Some banks will let you get 10 actually, okay? With conventional loans, the only limit they have is, and you want to write this down, guys, please write this down. It's called a loans to one ratio. And what that means is any lender can only lend so much money to any one borrower. Hence, that's why they call it loans to one ratio. It's typically, or it is, not typically, it definitely is based on their capitalization rate. So if the bank is, whatever the capitalization rate is, they can only lend a certain percentage of their capitalization to any one lender, to any one borrower, excuse me. And it may be $1 million, it may be $5 million. It just, you have to ask the question when you get there. And I used to have multiple lenders that I borrowed from because at any one time I might meet their loan to one's ratio in one lender, and I'd have to go to the lender, okay? So bear in mind that they're definitely, you could borrow and borrow and borrow. I mean, I had lenders where I had 20 or 30 mortgages with them, right? You know, as long as I had a good track record and I was proving to them that I knew what I was doing and I could manage the income and expense of the properties in a profitable way, they would keep lending money up to the loans to one ratio, all right? So in any case, so more flexible. Also, you can get different terms. So let's do this. Let's go over to a calculator. And Billy, if you could do me a favor, actually, I'll use my own example. So don't worry, Billy. I know you're at a place where you can't talk right now. So let's use the mortgage calculator. Let's say we're going to get a loan for, hang on one second. Let's call it 500,000. Okay. That's 5 million. Sorry, let me take off. I got too many zeros there. Hang on one second. So 500,000. Let's assume we are going to put 20% down. All right. Now let's look, and let's say the interest rate is 3.78% in 30 years. So let's calculate what we get, and here it is right here. I mean, I can hit calculator, but we already know it's going to be $1,300 a month and some change. So hang on one second, and I'll bring this up. And what I'm going to do is show you guys the amortization schedule. So your payment, you're on a $400,000 loan at 30 years at 3.78 is $1,859.28 per month. Okay, so write that down. Essentially $1,860. Okay, so everybody write that in your notes. Now let's click on the amortization schedule, and this is really important. So this is where you're gonna, like today, Michael and I were having a strategy call, and we talked about the benefits of paying off a mortgage early. Now why isn't this supposed to give me the schedule? Maybe it is down below. Let me just scroll down below and see if they gave it to me. Hang on a second. Aha. Well, I don't know what I'm doing wrong here, but they're supposed to give me the amortization schedule. Well, here's a chart. Actually, you can look over the years. Look at this. Your balance is in blue. Your interest is here, right? Your interest is here, and your principal is here. Okay, so you can see over time, if you look at the curve on the interest, okay, you can see it's not a straight line. It's more like a parabola. It's a curve, okay? In other words, the amount of interest you're paying over time is more dramatic in the beginning. There's more interest. In other words, the front end of your mortgage, the interest is front loaded. You're paying more interest in the front and less principal in the front. Over time, you're paying more principal and less interest. Okay, so what that means is, if you think about it, let's say you're a lender and you lend money, $400,000 to me. Over a period of 30 years, I'm likely to sell the house and pay it off early. Well, the fact is in the beginning, I'm paying more interest, okay? And so if I pay it off early, say after 10 years, I've actually paid a lot more interest than I've paid in principal. What that means is the bank has made almost all interest, and they got all the loan, the loan they never actually, they didn't have to actually, the money was available to them. They had principal available to them. That's why bankers and how bankers make money lending to us, okay? I really wish I could show you the amortization schedule, because I'm okay with charts and graphs, but I'd much rather have the, here, let's do a view summary. Maybe that's it. Let's see if they give us a chart. Aha, this is what I wanted to show you. All right, so check this out. 30-year mortgage, first payment. 600 interest, the bulk of it is in, the bulk of it is in interest, 1260, and in principal is 600. You can see over time the principal part of the payment increases, the interest part of the payment decreases, okay? All right, and look at the loan balance. It doesn't really change much at first, but if you keep going over time, you'll notice you're paying larger and larger portions of principal, see, and smaller and smaller portions of interest, all right? And it doesn't even hit the midway point to well into the mortgage. Let's go down and find right about here. All right, check that out. 12 years later, you're finally meeting the point where principal and interest are about the same. See that? 922, 924, 927, 934. So right around here, in about 12 years, you're at the midpoint where your interest and principal are about the same. But look at the balance, guys. You've only paid off 25% of your mortgage, okay? And yet you've been paying into it for 12 years, 12 out of 30 years, okay? That's 2/5. You're going through 2/5 of the 40% of the term, and you've only paid down 25% of the principal. So the bank has got the odds stacked in their favor. They're winning this game, right? And as you can see, it takes you quite a long time before you really start making, and it's probably around the year, let's go at about 20 years. So that's going to be 37. Seems like a long time away, but believe me, it'll be here before you know it. So check this out. You just passed the midpoint on your mortgage, right up here. 2036, that is 16, that's almost 20 years later, you just reached the midpoint of paying off your principal, okay? And at that point, ironically, you're reversed. Now your interest payments are around 600 and your principal payments are around 1200. Isn't that amazing? All right, it took you 20 years nearly to get to this point, and you only paid off half your mortgage, okay? All right, I think I demonstrated this well enough. You guys okay with what I just showed you there? Let me bring my panel over and look for some questions before I show you a 20-year term. I want to show you what we learned when it comes to the future value of borrowed money, okay? So let's get some questions out of the way here first. Let's see, Jackie is saying, I thought you could only do an FHA loan for your primary residence. No, Jackie, you can do, FHA is the underwriting body. They're the body of rules for underwriting these mortgages, but you can get, Fannie Mae loans, Freddie Mac loans. Those are all loans that get sold on the secondary market, okay? And you can borrow, you can get up to, most cases, 4 of those loans, in some cases 10, on non-primary residence properties, okay? Let's see, Mark is saying Idaho is currently 10. Yeah, some areas, Mark, I don't know why the difference, because nationally chartered banks have to follow the same rules wherever they operate. The state chartered banks can definitely make up, they can be different state by state. And that's great. You can get 10 mortgages now, right? So, right. So this is Billy. Billy is asking, do you recommend buying with a loan from the beginning with 80% loan to value, or with cash and refi after? When you refi, I find that they only let you do 75% loan to value. It's generally true, Billy. Now, but the main part of your question, though, every situation is different. You have to look at each purchase, Billy, and make decisions based on its own merits. Now, fundamentally speaking, I'm going to tell you guys this. I don't like borrowing money. However, when you're first building an investment portfolio, it is expected for you to be more highly leveraged, okay? It's not unusual to be 90% leverage when you're buying real estate. I prefer to not be any more than 80% leverage when I'm growing a portfolio. My personal rule is this for Billy and for everybody else, is I try to get that down to 65% as quickly as possible. In other words, if I own $1 million in property, I only want to owe $665,000 in debt. In other words, I don't want to owe more than 2/3 of what I own. Now, I know I just contradicted myself, but what I'm saying is this. When you first make a purchase, yeah, leverage up to 80% if you want to. I did that for years. But with that property, within a year, I'm going to get that down to a 65% ratio. It doesn't mean I'm paying the loan down. I will pay off a little bit. But more importantly, I'm increasing value. I'm making strategic improvements to the property, and I'm raising the rents. And that's how you increase value. That's how you add to your equity position. And that's how you get that spread quickly to 65%. So my goal is for every property, get it from 80 to 65 within a year by making improvements and raising rents, okay? And great conversation today. Michael has experienced that personally with a property he owns. It quickly started going up in value, and his loan position is now not even half of what the building's worth, okay? So in any case, that's part one. Part two is this. It has to do with paying cash and refinancing later. Here's why I like that, Billy. Let's say you're up and running, and you're able to pull equity out of your properties by using a blanket mortgage, blanket loan, or you have cash, some combination or some way for you to offer cash. I definitely like that because you can get a better deal. Cash is king in the world of business, always has been, always will, okay? And in fact, you can refi in some lending institutions, Billy, in less than a year. In fact, as soon as you buy the property, as soon as you take title, there are banks that will lend you money right away on that. Let's say you buy a house or a fiveplex, whatever, and you fix it up and you get it rented out and raise all the rents, and it's only been 2 months. Yes, there are banks that actually will loan you the money based on the current value at the time you apply for the loan. So it's not always a year. Yes, you're going to run into that a lot, Billy, but just be prepared that you can find lenders who will give you money, whenever you want it. All right, you don't have to wait a year. Now, as far as the strategy goes, a lot of people can't do that, Billy, right off the bat. They just have to do the 20% down thing and finance the rest. Okay, so usually people don't do that, the pay for cash technique and refi later until they're up and running, which is exactly what I did, by the way. And you'll start to grow a lot faster that way. So excellent question. Okay, let's see. Fassel, hey Fassel, how you doing, buddy? Hey, I heard from Roger Fassel. He got a new listing from the letter, I think just within the last couple of weeks. Okay, so how about if you put an extra $300 a month towards the mortgage? Would that go towards the? Good question. So Fassel, you actually have to specify. Don't ever leave it to chance. So if you're going to send extra money in, and Michael, I forgot to mention that today, always put on there applied towards principal only. Whenever you make extra add on to your payment, make sure you make the statement in there, apply to principal only. Now, so Fassel, over time we talked about a few strategies on another call earlier, and one of them is if you have a paycheck where you get paid every 2 weeks, in other words, every 14 days versus twice a month, that's different. If you get paid twice a month, that's 24 paydays in a year. If you get paid bi-weekly every 14 days, that's 26 pay days in a year. So what you do is you send in your mortgage payment every other paycheck. And by the end of the year, you will have sent in an entirely new additional 13th mortgage payment. That's one technique. Another technique is you can pay bi-weekly. Okay, if the lender will let you do it, a lot of times you can do that. You can pay bi-weekly, and that'll add a little bit of, you're paying, every month you're putting in an extra principal 2 weeks in advance. Okay, and that reduces the interest charges over time. But another option is this, Vassal. You can actually, this is an advanced technique. You could literally cut your payment, your term in half by doing this one thing. Everybody just take a breath and you can write this down. If you look at your mortgage statements, you'll see you've got principal and interest just like this, okay? Just like this. What the strategy is this. Every monthly payment you send in this case $18.59, you include an amount, an additional amount that's equal to the next month's principal. You add that on. Okay, so if you go back to the early years of this mortgage, let's just go back to the beginning. What I'm getting at is if you start from the very beginning, we're getting closer. Hang on one second. Okay. What I'm suggesting is this. On top of 1859.28, you add 601.17. You add 601.17 to this 1859.28. Now that payment becomes 24.60 and some change. You still make the next month's payment next month, including that principal portion. Of course, you can't get away from that. But in that month, you add another additional amount equal to the following month's principal. What I'm saying is each month you're adding an equivalent amount, an additional amount equivalent to the next month's principal portion. You still make that payment next month. I'm not saying you pay it early. I'm saying you double up. You're adding an amount equal to the following month's principal. You do that, you'll turn a 30-year mortgage into a 15-year mortgage before you know it. Okay. In any case, I just want to share that with you guys. It's a great little strategy. Okay, so Vassal was asking, can you do the FHA or VA for 15 or 20 years? I think you can. Boy, Vassal, I never got a VA loan because I'm not a veteran, but I used to assume VA loans in my younger days. And let's see, what was the other, VA or FHA? Oh no, on FHA, generally, I'd never seen them do a 20-year loan. You can ask them to do one, but generally it's going to be 30 years. Okay. In any case, I want to, let's see, this is Devin. Hey, Devin, how you doing, buddy? All right, Devin's asking, do you recommend having a separate LLC for each property? Most of my commercial investors seem to do this. Hey, Devin, a couple things. If your investors are buying smaller properties, single families, duplexes, triplexes, fourplexes, things like that, I would say generally not, because that's a lot of extra paperwork, especially when it comes to filing taxes. You got to pay fees. You got to pay your tax accountant for every one of those gets a separate return, and you got to pay for all that. Okay. You also have to have for every LLC meeting minutes. Okay. You got to keep track of the management of the LLC, because if you ever get audited and they determine that your LLC really is not an LLC, it's just you trying to shield yourself from liability, they'll do what's called piercing the corporate veil. Well, all of that paperwork, all that extra documentation takes time and money. So what I'm getting to is this, Devin. My personal philosophy is this. I never want to have more than $1 million in any one LLC. I want to spread my eggs across multiple baskets, but I do it strategically. I figure if I've got $10-20 million in properties, and I've only got no more than $1 million in any one property, and that's at the time of initial purchase. It'll over time, of course, $1 million in real estate holdings over a 12-year period is probably going to be worth $2 million, right? I'm not changing LLCs at that point. I'm just saying initially I start off with $1 million in any one LLC. To me, that was my safety zone. So Devin, for you and your investors, everybody's going to be different. For some people, they want a separate LLC for every property. Other people think that's nuts, and they'll put everything in one LLC. And you'll have people like me who are more strategic, and I just want to have it's based on a dollar amount. What is my risk threshold? okay? And so, by the way, if I'm buying $1 million building, yes, that will get its own LLC. So, excellent question. Okay, Billy says, hook me up with a lender. Hey, Billy, a couple things. Start with the local community banks, okay? These are the ones who are more likely to be portfolio lenders, okay? They're generally easier to work with. They're more flexible. They really just do due diligence on the project. They're not trying to fit you a round peg in a square hole. That's the problem with the big banks is if you don't fit a particular mold, they just boot you out of the system. You don't even know why, okay? But then you go to a local community bank and they're like, sure, come on in, you know? In any case, let's get back to this, guys. I want to now show you what happens when you do, oh, doggone it, let me go back here. When you do a 20-year mortgage, okay? Here we go. So, where's my, let me go back up to the top. Sorry, got to get my bearing straight. Okay, $500,000 loan, 20% down. We're going to make it 20 years. Oops. 20 years, okay, or 240 months. Now, assuming this is a conventional mortgage, you might be paying more, something like, let's just say 4%. Remember that usually the shorter the term, the lower the interest rate, okay? Usually the shorter the term, the lower the interest rate. But when you're going commercial, you're going to pay slightly more. I'm going to assume this is a conventional mortgage. So I'll be, matter of fact, I'll just keep it the same, 3.78. I'm going to get a conventional mortgage at 3.78. Okay, and let's do the calculation on that and see what we get. So hang on one second. All right, you can see the payment went up to $2377.80. So that's about $513 more than if you did it for 30 years. However, let's look at the amortization schedule. Hang on one second. I got to scroll down here, make sure I do this right. That doggone did the same thing. Hang on one second, guys. There's supposed to be summary. Here we go. All right. Let's look at the summary and scroll down. And if you look at the principal and interest, guys. Look at what happens here. We're paying almost the same principal as we are interest. Yes, the mortgage payment is higher by $500, but we're paying a much higher percentage of principal relative to interest than we ever were with the 30-year mortgage. Remember the 30-year mortgage started off at like $600 principal and $1,200 something interest. So what I'm getting at is this: is what changed here when you went to 20 years? It wasn't the interest. The interest didn't go up, but your principal portion went way up. Okay, almost every dime you're putting in extra is going towards the principal. So let me check for some ahas here. Just type in Yahoo or I got it or I figured this out as to why we like 20-year mortgages. Got it. Excellent. Everybody's typing this in. So the bottom line is, over the years, you're paying interest principal off faster, 20 years obviously versus 30. I know that sounds obvious, but you're paying a lot less interest. And check this out. Let's go down to see where we are at the 25% part. So at around 7 years, you got the thing 1/4 of the way paid off. Remember the other way, it took like 12 years to get to that point, right? And at that point, you were still paying predominantly more interest. So let's keep going here. Let's get down to 200,000 because that was half of our original principal. All right, and if you look, that's at year 29. So at 12 years, you're now halfway paid off. Doing a 30-year mortgage at 12 years, you're only 25% paid off. You've paid 100% more of your mortgage than you did on the 30-year term in the same amount of time. Just freaking amazing. So the other thing I want you to think about is this: did the payment go up? Yes, most certainly did. okay? But if you factor in the future value of all these dollars over time versus a 30-year mortgage, you'll find out that this is the optimal term, 20 years. And I don't know, I can't, believe me, there's a whole formula for this, and I could show you scientifically how it actually works, but just know this. Your payment is not going up commensurate with the decrease in the term. You've knocked off 1/3 of your term, literally 30 years to 20 years, but you did not increase your payment by a full third. Okay, you follow what I'm saying? So the increase in your payment is the increase is less on a percentage basis than the decrease in your term. That's so Billy and Michael, that was really the big thing I want to show you guys tonight, is there actually is a scientific reason why 20 years is better. It's not just because you pay over a shorter period of time, which means less interest. There are some real, honestly good, you're making better use of the borrowed funds, okay? In any case, let me do this. Let's see if we got more questions here. Let's see, this is from Mark. So hang on one second. Let me get back to the beginning of Mark's comment or question. Okay, the challenge is getting positive cash flow with 15 to 20-year mortgages once you figure taxes, insurance, at least in today's market. Yeah, that's absolutely true, Mark. So for me personally, guys, what I did is, just so you know, I actually started off with 30-year mortgages, okay, because I was new, I was young, and I just wanted to get the lowest payment I could possibly get so I'd have more cash flow coming in, okay? And so I did that for several years. And then later on, it really hit home as to why I was glad I switched to 20-year mortgages and eventually 15-year mortgages. And that is, when I started selling the older, smaller properties, so I was like 12 years into it. The mortgages that I had taken out for 15 years were far more paid off. And I bought them later on, by the way. I owned them for fewer years. They were far more paid off than the properties I had purchased years before with a 30-year mortgage. In fact, I made more gains on the later properties that I, basically financed for shorter terms. I had much greater equity positions. And so when I was doing things like selling and refinancing, by the way, and doing commercial lines of credit, I was able to pull out far more money far faster on those properties that I took out the shorter terms on. So it's one of those things, short-term pain, long-term gain. I will also tell you this is what happens is over time you become more astute with your investing skills, and you learn to invest outside your area. So like Mark was talking about, I mean, my gosh, Idaho is one of the most beautiful states I've ever been to, and the rest of the world has been discovering that. So you've noticed, Mark, same thing over in Oregon too. Like Bend, Oregon's gotten to be a real hotbed for a lot of people moving from other states. It's a great area, so it drives up prices. But in any case, what I'm getting at is when you get into the investing game over time, you start to invest outside your area. That's what Billy's doing. I mean, I know people that invest literally coast to coast, including me. Years ago, though, I wouldn't do that. So what I'm getting at is you'll have more opportunities to do shorter terms as you gain more experience investing. Okay, that's the point I was trying to make. Start off with who you are and where you are, whatever you're doing, just start there. Just take what the market gives you, okay? Once you gain a little bit of experience and you build up some competence and some confidence, you can expand into different areas where prices are lower, right? But remember, not every strategy requires you to have the lowest priced areas. There are investors who invest in Vancouver and San Francisco, some of the most expensive places on the planet, okay? Like New York City, for example, all right? And they still invest. Now, they will put down more money. So, Mark, what I'm getting at here is the final piece of this puzzle is, like me, we'll start to put down more money. We'll pay more cash. Not only do we get better deals, but we're financing a smaller dollar amount. That also allows us to finance with a shorter term. So the payment is higher dollar for dollar on the borrowed money, but we're borrowing on a lower, we're borrowing less of the value of the property. So instead of leveraging 80%, we might leverage at 65% or even 50%. So you remember I told you about my ratio? I wanted to be at 65%. So when I got to the point where I could purchase at 65%, I would automatically do the 20-year terms, right? So good question, a good statement there, Mark. I appreciate you bringing it up because it allowed me to further explain the strategy. Okay, so Brian is asking, why is 20 years better than, say, a 15-year term? Well, it has to do with the value of the borrowed dollar, Brian. So let's do a 15-year term. So everybody wrote down 2377.80 on your monthly payment here, and you can see when you break even, all right, on the principal part, and you saw that right away, I mean paying down your principal, that is, and you saw in the very first payment, you literally at almost 50-50 principal to interest versus a 30-year loan where it's more like the principal was 1/4 of your payment. Okay, enough said. Let's go back and type in a 15-year term, excuse me. So let's go here and type in 15, okay? And let's just keep the rate the same. You know, the fact is, yes, you will get a lower interest rate the shorter the term. Now check this out. Everybody write that down, 2914, okay? So the payment now went up 540 bucks, okay, 540 bucks. The first time around, it went from 1860 to 2377, so that went up 513 bucks. This is going up 540 bucks. So you'll notice right away, Brian, reducing our term from 30 to 10 years added 513 bucks to our payment. All right, reducing it by only 5 years from 20 to 15 actually added more to the payment with a 5-year reduction than we added with a 10-year reduction. You follow what I'm saying there? So this adds dramatically to your monthly payment, and yet you've only reduced it by an additional 5 years versus 10 years using the other approach, okay? So that's part of it. But let's go and check. Okay, come on, computer. Let's see. Here we go. View summary. Let's go down here. And by the way, I use bankrate.com, guys. I love bankrate.com. It's very flexible. You get all kinds of cool tools. So let's go here. So check this out. You'll notice that before we went from a 75% interest, 25% principal on a 30-year mortgage to nearly 50-50 on a 20-year mortgage. But check this out. Yes, our principal is more on a 15-year mortgage. The interest hasn't changed, but the principal now is only just less than $400 more, okay, by going down only 5 years versus going down or adding $600 more by going down 10 years, okay? Very important to just kind of ponder that, what I just said there, and you'll see why. Let's just go down here now so we know where we're starting out at. Let's see where we get to 25% paid off of the mortgage. Okay, let's see, here we go. Right around 2022, so that's 5 years out. So at 5 years out, you've got 25% paid off on your mortgage, okay? And you're now at about a 2/3, 1/3 ratio on principal versus interest. Let's go see where we got it halfway paid off. Let's go down to 200 grand, and we're getting pretty close. Yep, there we are. Okay, 2026, so we're about 9 years out, right? And we're now at about a 75-25% ratio on the payment. Okay, and of course, another few years, we're going to have this thing paid off. So we're now at about just past the halfway point. So halfway through the mortgage, we've got this thing halfway paid off. Okay, now, if you remember back to the 20-year mortgage, where were we at the halfway point? We were at year 12, okay? Think about that. Year 12 out of a 20-year mortgage versus year 9 out of a 15-year mortgage. You tell me which one is in your favor. Well, it's the 12 out of 20, right? If you look at the value of the borrowed dollar over a long period of time. So in any case, Brian, I appreciate the question, man. When I had this demonstrated to me back 20-something years ago, it really was an eye-opener for me. And I noticed that a lot of the savvy investors that I was attracting and working with, they all did 20-year mortgages, and then I figured out why. I actually took a commercial called CCIM class. I took several of them, and we actually discussed this very topic over a several-week period. And it's pretty, I mean, if you're like a numbers person, this stuff's pretty awesome. I mean, if you really think about how amortization works, some of you probably want to be the lender. It's actually at some point, let me ask this question. How many of you at some point want to be a lender? Like when you've got your properties 10 years from now, 20 years from now, and you got a lot of them paid off, would you like to lend money to other investors so that you can help them grow a portfolio like you did, and yet you benefit from this? Look at this. Look at the payback. Look at your return on investment. Okay, it's amazing. So let me see your comments here, and I'm going to go back to questions and make sure we're all good on the questions here. Okay, so are you recommending only to take shorter terms? So Jonathan, I've kind of sort of explained that. Yes, the answer fundamentally is yes. I definitely prefer shorter terms. However, you know, Mark brought up a very good point, and that is when a lot of times when you're first beginning investing, it's hard to have a lot of money to put down, you know, in order to get a shorter term. It's harder to find the properties allowing you to get a short term because generally you're investing where you are in your area. And if you're in a highly densely populated area, generally those values will be higher. I mean, there's some obviously exceptions, but let's face it, if you've been around, traveled around the major cities in US and Canada, you know, Toronto, Montreal, Vancouver, you know, Boston, which is where I am right now, LA, San Francisco, Washington, DC, Chicago. I mean, it's more expensive, you know. So back to your question though, I would say do what you can do right now with who you are and what you have. And if that means get an FHA mortgage, nobody's going to spank you for it. Just know that you're going to pay for that long term. It's going to inhibit you later on from being able to grow. It may make you feel better now because you actually got in a property with some more cash flow because you had a lower monthly payment. But 10 years down the road, if you go to refinance or pull out equity, you're going to be limited. It's going to be you're going to have a smaller position to work with, as opposed to if you had done a 15 or 20-year mortgage. I want you to think. Write this down, guys. Keep one eye on today and one eye on tomorrow. All right. You've got to think through today and think through tomorrow. And I know Mark knows what I'm talking about because he and I are about the same age group. But you've got to have one eye on today, one on tomorrow. So whatever you do today, don't do something that's going to hurt you later on, right? Or inhibit your growth later on. Do something that works today, but positions you for growth later on too, right? So everybody's saying, yep, exactly. It's okay. Okay, so this is Guadalupe. Hey, Guadalupe is asking, what is the impact on your cash flow? Do the gains later make up for the reduction of cash flow? That's a good point. Yeah, the fact is, guys, yeah, if you take a shorter term, so let's say you did the 20-year term like I suggest, your monthly cash flow, your net in your pocket on rents is going to be slightly lower. But what Guadalupe is saying is over time you are going to raise rents. So you're going to make up for that too. That's the other thing I didn't mention earlier. Absolutely true, right? Okay, so everybody's getting the big picture here. What I want to do is, actually, here's Gregor. Gregor says, yes, I would like to lend money. Excellent. And Greg, I can't remember, are you in Canada? I think you're up in the Toronto area, right? Hey, by the way, I'm going to be in Toronto next week, so keep in mind. Hamilton, excellent. So we're going to be, matter of fact, I'm going to be with you guys Monday night. What's the name? Let's see, where's that? Well, in any case, let me get back to this. Anybody that's in the Toronto area, please check the schedule and let me know if you've got a workshop or something coming up. I'm doing one Monday night with another student, and it's going to be a pretty awesome event. In any case, I lost my train of thought. Well, here, what I want to do is this. Let's go back to Billy's question here. All right, because he has some more stuff in here. Would you advise I transfer title to my personal name right away in order to do a cash out refi with Fannie Mae because loan's right? So Billy, I hope we answered part of that in the first part of class tonight. The other part is this. Keep in mind, whenever you transfer title, and this is true in most states and also in Canada, even though you have a property in an LLC and you own the LLC, if you transfer the property to your own personal name, you're likely to incur a transfer tax, and they're not kind. I mean, it could be 1, 2, 3, 4%. You know, even though you didn't actually sell the property, the fact that you transfer title kicks off an automatic transfer tax at your provincial level, if you're in Canada, and the state level, okay, and also potentially local level. So bear in mind that that's a, and by the way, usually people go the other way, Billy. They go from personal title to LLC title, or in Canada it'd be a company or corporate title. They don't have the LLCs in Canada. Also, you can go to a non-FHA lender. You can go to a conventional lender or a commercial lender, right? And they're not going to ding you with that what they call a seasoning, 6 months or 1 year, whatever the case is. So look for a community bank who's doing conventional loans, right? They're not, they're portfolio lenders, and ask them, will they do it just the way you have a title now, which they should, because all they're going to do is have you do a personal guarantee on a loan, right? Okay, so that was, I think we cleared up Brian's question. Let me go back to the questions here because we're getting short on time here, and I want to make sure we got everybody covered. Let's see. Yeah, Diane. So it's Diane. That's, hey Diane. Yeah, I know that's. It's actually Tuesday at Ancaster, so I'm going to be there with my boots on, ready to rock and roll. Yeah, I think I said Monday by accident because I think we're originally shooting for Monday, but Diane, it is absolutely Tuesday night. So thank you. And also, let me know if I need to bring my projector. I can do that. I've got it in London. I'll bring it with me. If not, if the facility has one, we can just use theirs, okay? And then also, I did have a great call the other day. So if we need to do one more, Diane, on Friday, I'm driving from, if you can believe this, from Boston to London. So I'll have all kinds of windshield time. If you want to do I think we should probably do a quick catch up before Tuesday. So, okay, Diane, 26 at Pub Fiction. Yeah, I've got the address. Everything is all set. Okay, Guadalupe is saying, is there a tax from personal to LLC? Yeah, so Guadalupe goes the other way too, man. As soon as you transfer title, they're going to ding you, right? Okay, let's see. This is Michael. So Michael is asking, so if I buy out my invested property from the bank, and if I lend money on my property, I'm basically a private lender. Yes. So you can, being a private lender, I know a lot of people that do that. And one of my best friends is actually a private lender, and he does all kinds of neat stuff. He's very creative, and he's been burned before, but he doesn't like punish people. He doesn't punish everybody else for one person coming up short. I've actually helped him sell properties that were in default, where there was multiple mortgages, and we were able to get the train across the tracks and into the station successfully, and everybody actually got paid and made money. You know, we got some pretty amazing stories there. Let's see. So let's see. Where can I get more information on this topic? I tell you what. Let me see. I'm going to see if I can find one of my old books for you, Michael. I've read like 3,000 books, but more importantly, I'm going to bring in a special guest in November who's going to talk about lending and how do you work with private lenders. So let's save that question for him. He's an awesome person. He lives right on the beach in North Carolina. I've known him for years. He's an investor. And what I'll do next week, guys, is by the way, we have a special guest next week. His name is Brian Devine. Actually, you want to be on this call. He markets to dentists. He has his business, caters to dentists who want to grow their business, and he helps them through marketing and grow their business. He's going to come on next week and talk to us, how do we actually talk to dentists. He's also breaking into the chiropractor world, so we're going to learn a lot from him about how we can talk to dentists and chiropractors. Now, the following week, what I was going to tell you is this. I'm going to go over the booklet. Well, obviously, we never got there tonight. I'm going to go over the booklet with a checklist. I'm going to show you a checklist right here. Hang on one second. I'm sorry, on how you use the booklet. Okay, so that's going to be on October the 4th. And then some really good news is on October 12th, we have Ryan Snow coming on. Ryan Snow helped write the book, Miracle Mornings with Hal Elrod. It's a New York Times bestseller. If you've never read it, I highly recommend you read it. He wrote the version for salespeople. You definitely want to be on that call. But in any case, what I'll do is we're going to go over this booklet checklist, not next week, the week after, as well as the booklet itself right here, to show you how you can drum up your own funding and or find investors to buy properties. You earn commissions from them, right? In any case, let's see who was next. Gregory, we're in Ancaster. Yeah. Hey, Greg. Greg and Diane, are you guys ever using a tool called GLR? I think it's GLR. I used it years ago when I was out in London. It's either JLR or GLR. If you can do me a favor, just type in, yes, we've used GLR. Just give me the link. And I want to, what I want to do is I want to get back on that platform because I'm going to help some folks up in Ottawa. And I just cannot remember what that tool was. I used it years ago. So if you know what that is, please let me know. I think it's GLR or JLR. Okay, so Diane says we got a projector. Okay, that's good. We'll do a quick call Friday. That's good too. Never heard of it. Never heard of it. All right, I'm going to dig up some information on that, guys. For everybody in Canada, there is another tool out there. If you look at the bottom of the resource page on your membership section, silver level, membership section on myinvestmentservices.com, you'll see two different documents. Both of them have websites you can use for finding out more information about your area, finding properties, ownership information, public records like court records. In Canada, there's more available in Canada and there is in the US. There's more systems. However, US data is more accessible, right? In any case, guys, that's pretty much it for tonight. I appreciate your participation. That was a pretty awesome call. I hope to shed some light on a pretty important subject for a lot of you guys. And I hope those of you who are not investing yet, that this gives you some ideas on how you can think about structuring your purchases. Also, in the meantime, I hope you have an awesome rest of the week. And we will see you on the 25th for the weekly webinar. And for those of you up in Ancaster, Gregory and Diane, I will see you the next night on the 26th at 7 p.m. Okay? Okay, you guys have a great night. God bless every one of you. And I look forward to seeing you next week. Okay, bye-bye.